We still have a very important session coming up. And as doctors, we have been told that you are not good at finances. And somehow we have found one guy in our community, oncology community, whom we can call as the Junjunwala of the oncology community. Dr. Bharat is there, and Bharat is going to take us through the financial planning, which is quite important for all of us as doctors. We are very much focused about the survival curves and the p values and hazards, but we also have the hazards of not understanding the financial lessons. So over to Bharat.
At the outset, I want to thank Dr. Vamshi, Dr. Nikhil, and especially to Dr. Purvis sir for giving me this opportunity. And it's not a forum to give detailed information about the finances and everything. I think we had 2 days of academic activity to know, how you treat your patients better. I think now we are more wise or becoming wiser day by day with immunotherapy, chemotherapy, targeted therapy. So, but I think finances are the key, very, very important because that makes you comfortable in your OPD when you see your patients. It relieves your insecurities that this patient will go to somebody else, take multiple opinions, targets and all those things. If you have a good backup and good sound knowledge that you have a good decent corpus or a good net worth, then you can play your cards well at the medical front, I feel. So let's begin. So compound interest, this is the key in finances. Whenever we talk of finances, we have to always think of compound interest. That is what Albert Einstein said, it's the eighth wonder of the world. Actually it is. Actually it works like that. So let's begin starting financial journey. Some advice for young adults wanting to start their money journey or everyone. So how to get more returns on investment? So there are 3 points: principal, interest rate, and duration. Very, very important. Principal we all have. We earn, we put in the bank, we do FDs. So we feel that we are secured and everything is hunky-dory and rosy. So the 2 points, interest rate and duration, the key. The more early we learn, the more wise we become and more free we become. That we'll see in subsequent slides. So if we see this calculator, these calculators are available online or on the web. If we see there are 3 parts. If we are having a SIP in any mutual fund or in any financial activity, if we are putting 15,000, suppose monthly SIP, and we expect a return of 15%, and our duration of SIP, we keep it 15 years. So let's see what happens. The investment amount at maturity is 1 crore. So we'll be keep changing the amount, the returns and the duration, and then we will see what comes. Suppose we increase the amount. We have money, we want to increase the amount, we want better corpus at maturity. So if we do a SIP of 30,000 with returns of 15%, at 15 years, the corpus will be 2 crore. So just it is double. You are increasing your amount, the corpus is double. There is no change as such. So if we increase the returns, if we expect our returns to be better, suppose we are investing in some good financial instrument and we expect that returns is 30%. See, by investing the same amount of 15,000 over 15 years, you manage to get a corpus of 5 crore. Just by manipulating or choosing a right financial instrument. So let's see the third part, which is the duration. What happens when? So if we know that we have to invest, we have to save, and we become wise early, that's the best part. So everything is same, 15,000, 15%, but years is 30 years. See, in 30 years, in that 15,000, with 15% rate of returns will become 10 crore. So just by investing early, so time is a key. Time is a key in investment. So important is we have to save money. When we get income, when we get salary, we think of paying our EMIs, paying spending. So I think first we have to save money. So there are two. I have just given an example. So there are two people, Mr. A, Mr. B. Investment age 25 year of Mr. A and Mr. B is 40 years. Both were doing monthly SIP, and you see the corpus which Mr. A gathered just by investing early and less amount, less monthly SIP, 3.24 crore. And Mr. B, in spite of investing higher amount of 15,000, managed to get corpus 1.49 crore. So an excellent habit to develop early is start with saving 10% of the income, what you are able to generate through your profession. Gradually increase to 20, 30 and so on. Practice this equation. Income minus spending, we thought of saving, but change it. Income minus saving is equal to spending. So first save and then spend. This is what we saw. The second point is we should have a emergency fund. So we should not feel that everything we should invest. So what is a emergency fund? It has to be 8 to 12 times of your monthly household expense. So keep that in liquid funds or short-term deposits, like you have liquid and debt funds, or you can keep also cash. Get health insurance early. Very, very important point. In India, it's said that you are just one medical emergency away from falling below poverty line. For self and family, very, very important. To get one personally, even your employer provides a medical cover, super top up. So insurance, the catch is always take a lower bracket like 5 lakh cover and take a top up. That helps because your premium really goes down. So take a 5 lakh cover, on top of that ask for a top up to 1 crore. So your premium will be much less. If you ask for a 10 lakh, 20 lakh policy upfront, you will be paying more. But you take a 5 lakh cover, basic cover, and take a top up. That's a catch in that. Term insurance, it has to be term insurance, no ULIP, no endowment. You don't get any money back if you survive the insurance period. But this is the purest and cheapest form of insurance, but dependents get a lot. So that is important. One should have a term insurance to secure the family. Avoid debt or use sparingly. Avoid borrowing to buy liabilities like car. Car is a depreciating asset. So always think, if you are taking a loan, take a loan for home, not for car or any aspirations. Ensure total EMIs should be less than 30% of your monthly income. That is a very, very important point. Many times our income is just 5 lakh and we think of taking 3-4 CR of loans, and then it is 3 to 4 lakhs a month. That is not a right approach. Start investing. So after creating emergency fund, getting health term insurance, money you need in less than 3 years is you should keep aside. Cash, liquid funds you can keep. If you require money for 3 to 5 years, you can keep it liquid funds and FDs. But if you don't need money for more than 5 years, then the best asset is equities. Equities is the best asset to get maximum returns. So asset class, equity, debt fund, fixed returns, real estate we know, gold and Bitcoin. Bitcoin is just, I have kept it, but it's just a gambling. So enemies of your investments, inflation. See, this is a very, very crucial point we neglect. that how our money which is in the bank is getting eroded by inflation, taxation and cost of managing the assets. So see inflation how it eats the money. See the value of 1 lakh which was 1 lakh in 1990, it has become just 15,000 in 2020. That's how the inflation works. We don't realize, but it's a crucial part of our life that gradually your money depreciates. So you have to invest in such instrument which beat inflation. That's the way you can save money. Worth of 1 lakh in future, if you see, if the 1 lakh in 2021 and in 2056 the 1 lakh will be worth only 11,000 rupees. So that is crucial that we should invest and we should at least beat inflation. I have taken the inflation at 6%, which is normally there in our country. So with equities, start with mutual funds. Diversified portfolio is the key. Flexi cap, multi cap fund, which have got various kinds of stocks like large, small, mid. So they have a mixture that can give a safety measure also and also a good decent returns. And index fund is very important because index generally give you 15 to 16% returns over a longish period of time, be it a bumpy ride going down and up, but if overall it gives 15 to 16% returns, which very well beats your this inflation. And plus it's a safe, see index will go up, whether there was a crash of 2008, there was a crash of 2020, it has to go up in one direction. That is a destiny of index and our country at this moment, if you see. So ALS is important. We tend to choose PPF as our traditional measure of tax saving, but I think ALS is a good measure. If you invest in ALS, you will be saving the tax, plus you will be getting good amount of returns, around 15 to 18% you can expect in ALS also. So not owning stocks, you see that around your colleagues, many people they talk of stocks that I am having this stock, that stock. So not owning stocks is not a shame. Sticking with mutual funds is also good enough because they are the wise people. They have a fund manager. They are churning their portfolio. They have a connection, so they can do a better job. Don't worry if others are buying stock and making fast money. Play your own game. Run your own race. That is important. So buy stocks only when you understand underlying businesses, their potential and risk. That's the key. See, in last conference, if somebody was there, I had a lecture in Dr. TP's house conference in Bhopal. I gave one stock, Electra Green Tech. At that time, the price was 500. Now it is close to 2000 in just 1 year. So it happens. But for that, this line is very important. Buy stocks only when you understand underlying business and you know their potential and risk. So if somebody would have invested 1 crore last year, it is easily 4 crore without doing anything. But R&D, research, study is very, very important when you are thinking of investing in stocks. So why I am saying is investment is important and where are we and why it is an India story. Look at our percentage. See, still the investment in stock market in our country is just 3%. Just 3%. Can you imagine? And US is 40%, 48%. So this gives a raw material for us that the growth is huge. Although the work which has been done for last 10, 15 years, the background has been laid, and the infra has been done. So I feel next 5 to 10 years is a tremendous growth in our country and the index can beat all its previous, records. Lose money, very important. So even if you have made a well thought out decision, you can lose money, but you should not lose heart. See, again, it's a bumpy ride. Stock will go or fund will go up and down. You have to stick, if you have to take a good decision, then stick with that stock or stick with that mutual fund or stick with that instrument. Okay, then the returns will come. Because there are many players in the stocks or mutual fund. Suppose the fund has got allocated, suppose the stocks which they are in the funds, they have grown so much that the allocation in those stocks is outnumbered, and as per some guidelines, they have to keep a certain level. So they have to sell those stocks. So at that time, the stock will also fall. The fund may also show some dent in the returns. And same thing goes with stocks. Stocks is going up, up, up. But there is a bad time in the stock. Suppose the quarterly results, the company is not doing well. The raw material prices, which they are procuring from other countries, are going up. So their input or their cost of making goods is high. So their margins are going down. That may be a temporary phenomena, linked to crude oil, all these, commodity prices. So this is just a cyclical thing. We should not lose heart that, my stock or my fund or my investment is going down. But in fact, if you have studied hard of that stock or of that instrument, that is the best time to add on to that position. Because then it will be a good position for you and it will bear good fruits. So don't lose your way. Attractive returns like influencers we see on social media. So finally, whatever you experience in your money journey, good or bad, remember everything is temporary and you must enjoy the journey and scenery that worry about a destination. That is a very crucial line. So take away message, start early, insurance, PPF. PPF is important. Why? Anybody can answer? Why PPF is important? Although we talk of returns, why PPF is important? Family. Everything is family. Yeah? If I am earning, I am making a corpus for family only. See, tax benefit is fine. Anything else? Interest what you get. Plus on interest there is no tax. That is fine. Anything else? See, PPF is the only instrument which government has had assured to every investor or every individual that you will get that money back or you will get that money. Suppose the bank or the fund collapses or the banking system collapses. So as per the government norms, this is the only secured money you have. Your money in bank, your money is investing, everything at risk. If suppose some earthquake comes, some scam happens. So government has laid down certain foundation that PPF is the only guaranteed money you will get. Whether mutual funds, your other FDs, they are not guaranteed. PPF is guaranteed that even any calamity, anything comes, government is liable to give you that PPF money. So that is why I always suggest that you should also have PPF apart from other. Not for tax saving, just for that it's a safe, secure instrument. So I'll give few rules. I think this looks interesting. Rule of 72, rule of 70, 4%, 100 minus 8. This will give some food for thought for all of us that how should we invest and what these rules are. See, rule of 72 is very important. Number of years required to double your money at a given rate. You have to just divide 72 by that interest rate. Suppose if you want to know how long it will take to double your money at 8% interest, divide 72 by 8. That means 9 years. Current FD rate is 7. Suppose 6. At 6%, it will take 12 years that your money will get double. And at 9%, it will be 8 years. So, good rule to know. Rule of 70, it's for the inflation. Divide 70 by current inflation rate to know how fast the value of your investment will get reduced to half its present value. So inflation rate of 7% will reduce the value of your money to half in 10 years. 4% rule, corpus required, it is for the financial freedom. So corpus required 25 times of your estimated annual expense. So 25 times of your estimated annual expense. Suppose you want to retire at 50 years, okay, and your income is 5 lakh, at that 50 year 5 lakh and you wish to take VRS. So you will require 1.25 CR so that you can live peacefully without any trouble. Put 50% of this fixed income into FD and 50% in equity. Withdraw 4% every year, that is 5 lakhs. This rule works more or less well for 96% time in 30-year period. 50 plus 30 is 80 years. So you can live peacefully. 100 minus your age rule. This rule is used for asset allocation. subtract your age from 100 to find out how much you have to invest in equities. Suppose your age is 30, so 100 minus 30 is 70. That suggests that you should be risk averse. You should invest 70% of your savings into equity, 30% into debt. But if your age is 60, your equity percentage goes down to 40 and debt increases, because you want to be more safe at old age. 10-5-3 rule, one should have reasonable returns expectation. That means 10 to 15% rate of returns from equity and mutual funds, 5 to 6% from debts like FDs, and 3 to 4% you can expect from your bank account. 50-30-20 rule for allocation of income to expense. Divide your income in 3 parts, like 50% should be needs, like groceries, rent and EMI. That is needs. 30% your wants like entertainment and vacations, and 20% is savings for your investments. But I feel you can save more. 3x emergency rule. Always put at least 3 times your monthly income in emergency funds for emergencies such as loss of employment, medical emergency, extra, etc. So 3 into monthly income, current monthly income into 3 times. You can put 6 into monthly income also, and that can be, you can put in liquid funds. There are various liquid funds which gives returns like 5 to 6%, and you can anytime withdraw. Within a day, they give the money in your account. 40% EMI rule, never go beyond 40% of your income into EMIs. Say you earn 50,000 per month, so you should not have EMIs more than 20,000. Very crucial. This rule is generally used by finance companies to provide loans. You can use it to manage your finances. Life insurance rule, always have sum assured as 20 times of your annual income. 20 into annual income, say you earn 5 lakhs annually, you should at least have 1 crore insurance by following this rule. Thank you. Thank you very much.
Very nice. As I asked, आपका net worth तो बता दो हम लोग को.
Sir, nothing. I am still a beginner in this journey.
Okay.
See, I am a small cap and a micro cap investor. My specialty is that and soon we are also launching one capital ventures which will invest in startups and also in small micro caps by looking at their balance sheet and fundamentals and some information from them. So because that is an area which is I can tell you from my experience, maximum earning can be made, because those are seeds, small companies. You know, simply like I can give you example of a large tree and a small plant. Okay, large tree has got nothing to give you, like Reliance. It's a big tree. See, the Reliance current market cap is around 20 lakh crore. If the stock price has to double, just giving you food for thought, has to double, the market capitalization of that or the net worth of that company has to be 40 lakh crore. 40 lakh crore. Are we ready? Are we convinced that that company will achieve in next 5 years? Oh, that is why large caps always gives 10 to 50% returns. These small companies like small plant, full aspirations, they can become a next Reliance. A full blown tree can be made through them, because they have a full, they are aspiring in that sector. They are growing fast. So if we know right companies, if we can invest in them, then the story is completely different. Your money can easily double each year. Even 3x, 4x you can generate return. But yeah, risk is also too high, because you are taking a risk on a new promoter, new company and new management and new management.
So Bharat, my question was, India is right now sitting at 3.8 trillion
Yes.
economy. By assuming Modi government comes into the power, next 4 to 5 years, we are definitely reaching 7 trillion. Yeah, of course, these are the, this thing. For that to happen, everybody knows the index should reach at 1.5 lakh, which is, right now 70 or uske beech mein chalte rehta hai. Isn't the index funds the safest way, matlab, of course, the
Yes,
risk
yes.
is there, the safest way to double your money?
Yes, yes, yes. See, in long term, if we want to play safe, I think index is the best. Index is the best. Index funds are the best because they are collaboration of all the stocks, by and large. Many good companies. That is why in long run, if we see the 2008 crash also, at that time also, if we take an average of 5 to 8 years, the returns was 15%. But what Dr. Amish is saying, at this point of time, I can easily tell you the returns will be 25 to 30%. The way the economy is going, the way the financial analyst or economics see where we are going, see the UPI. See, even the auto rickshaw or your cab, many times you don't get change. They ask for UPI. So the money is thrown into a system. Okay. So our country is going in a right direction. So what Dr. Amish said that index fund at this point of time, I see that 25 to 30% growth can be seen on yearly basis for next 5 years. That is what I see. Previously, we were getting 15%, but now I think around 25% is expected. But in this period only, the stocks will generate 10x, 20x, and 100x. That is how the stock behaves. If the index doubles, stocks will become 10 to 100x during the same period. So if you are okay, if you want to play safe, then index is the best. But if you want to exponentially grow, then you have to find a good fund manager, or you have to study and find good companies to invest. That's how it is. But I think in whatever you are doing, be it stocks or be it mutual funds, diversify portfolio is a key. Suppose you are having a mutual fund. I can give you one example. Mutual fund should be you should have one multi-cap fund which has got large, small, mid-cap, one large cap fund, and very importantly one small cap fund, which is a risky affair. But I will tell you that a small cap fund will give alpha to your portfolio. So small cap fund should be there in your portfolio, be it in less quantity, but that will give good alpha to your portfolio. Small cap fund, multi-cap fund, and one large cap fund. That will balance the portfolio very well. See, last year, if you see the quant companies there, their small cap fund in last 1 year, just fund, because I am holding that fund. So fund has given me returns around 82% in just 1 year. Although the market was going up, but that's how you can get alpha. And you are rest assured that fund is being managed by a fund manager. If you don't want to play the stocks, at least identify these small cap funds, allocate in them, and allocate some in large cap and some in mid cap. Don't bother about the stocks and other things. These small cap funds can easily give 40 to 50% return in a year. If they are, because they have each small cap fund has a gamut of 25 to 30 good small cap companies, which they have analyzed on their parameters, which are growing, and they need funds, so they provide funds, and then they formulate a policy for them. So that is why small cap fund should be there. I feel if you are not interested in stocks, leave it. But small cap fund can give you that alpha which one is looking at in their investing journey.
So I have been an investor for a very long time. Just one quick question. Compared to PPF, do you think GSEC is an equally good debt for money protection?
Yes. GSEC, they are government bonds also. One can do that. And other things is, nowadays, if you see, there are various companies, they are coming with real estate. Real estate fixed returns, like 17-18%. And plus the RERA also. Real estate, there is some term is there. They give 17 to 18% returns on the assured returns, like FD.
But do you think that, just opinion, what you personally feel, do you really think that real estate is going to be a boom in the next 10 years like equity?
Yes. If you see, real estate has seen a bad phase for last 15 years.
Yeah.
So this is the time real estate will boom. See, our infra is growing. The road is going to the land where nothing was there. If the road is reaching, so that area will get developed. Obviously, like Gift City.
So you mean
See the
basically
example
land.
of Gift City.
You mean basically land? flat is not in this box, right? By if somebody
Anything,
buys a flat,
suppose the Modi ji is developing Gift City as a financial hub.
Right.
So nearby area will be like a residential for them.
okay, that way, collateral benefit.
Yeah, obviously. See, highway development, infra development. See, I can give you one example about defense because I studied a lot defense. See, defense, what they did in 2020, they said that we will not import anything from Russia or other countries by and large. We should have a Make in India initiative. Then Modi ji started giving PLI schemes and promoting them. That we should have all the equipments and all the machinery in house, and we should start training, technology sharing. Everything will be done in India. Then many of the companies send their representative to Russia to learn the technology, and they also came to India. So suddenly, if you see past 2 years, defense companies, where they have gone. Now defense companies, they are planning to export. Earlier we were importing everything, now we are planning to export. So this will be a good sector for next 5 years, 5 to 6 years. Because we were importing, now we are exporting, started to export. So I am holding one company in this space, Krishna Defense. I have told 2-3 times. So very good company, I know the promoter and what they are doing. See, you have to understand the vision of the promoter also. See, you can't just invest like that in small company. You have to talk to them. What they are up to. Whether there is any vision or it's just like that they want to. Many small companies I know in Mumbai. So what they do is, suppose the IPO is listed, they keep checking their stocks. They forget their business and they just behave like a stockbroker. As if the stock price is very important to them. They keep manipulating with the broker. So many times, this is the small company, you can make money, but you can lose money very fast. Because many smart players, they are having an access with the operators and brokers, and they can, you can easily lose money.
And are you a big fan of pharma?
No. I don't invest in pharma. I invest in defense and smart meters, recently electricals, EV we have, last year we have green energy, obviously. But anything is good. If you see, it's like a cycle, anything is good. But yeah, at this point of time, pharma and chemical industries are going through a stress. So one should be away from that. Or one should invest at the bottom, those who know well. But this is the best time to invest also in chemical and pharma. But those who can't take stress, then you have to stay away. Thank you very much.